Good morning, everyone. It's Friday, the 2nd of July today. Welcome to ANZ News. And today we're talking, will the RBA need to start QE? The RBA meets this coming Tuesday to decide on interest rates and their program of yield curve control. For an institution that has categorically said they don't see rates rising until 2024, no one is expecting any change in rates next week. They are also already basically at 0.1%, and have also categorically said they won't drop rates any further. That, of course, leaves the money printers. At a time when Joe Public seems to think everything is awesome, what do we expect from the RBA from here? Yesterday, we saw the annual report released for the Conversations July 1st, a forecasting survey of 23 of Australia's leading economists from ABC News. On balance, the panel expects year-average economic growth, the measure reported in the budget, to slide from 4% this financial year to just 2.2% by 2024-25, well below the average of 2.6% assumed in this week's intergenerational report. The panel forecasts much weaker business investment than does the budget and lower household spending, but higher wage growth and lower unemployment. It expects a flat share market and slower growth in house prices. Welcome to the RBA's dilemma. Just as the headline act of the US Fed is stuck between rising inflation, but clear signs of a weakening economy this half year and everything inflated by cheap money, so it seems our RBA may be too. Charts like the following don't scream it's time to tighten, and indeed will be screaming to the RBA that maybe they need to do more. The considerable spread of forecasts, each of the pale pink lines is one of the 23, also highlights how uncertain these times are, irrespective of people's views around any comparisons between economists and weathermen. Critical assumptions around vaccination rates, borders reopening, and immigration restarting have massive impacts, and the two most bullish below basically assumed all of those are imminent. The other concern for the RBA is the panel collectively saw these crazy high iron ore prices to stay for longer than the budget predicts, which of course is bullish for the AUD, not something the RBA wants to hear. For an economy with one of the most bubble-like housing markets in the world, challenged only by New Zealand, Canada and Switzerland, driven purely by low interest rates and rampant speculation, all eyes are on where interest rates are headed. There are two factors at play here. What the RBA wants rates to be and what the bond market decides they will be. Again, from ABC News we have. Over the past year, the bond rate at which the Commonwealth Government can borrow for 10 years has jumped from 0.9% to 1.5% in accordance with moves overseas. The panel expects further increases to a still low 1.8% by the end of this year and to 2.2% by the end of next year. Even so, the panel expects no increase in the Reserve Bank's cash rate, the one that drives variable mortgage rates, for almost 2 years until April 2023. So how about government's bold prediction of 12.5% non-mining business investment beyond this year? The panel saw that being less than half at just 5.8%, but importantly, gave the reason of not just low population growth, but also because the government has already sucked forward all it can. You could apply this same logic to the Aussie property market that has sucked forward a pile of demand through grants, incentives, and of course, record low interest rates. With little foreseeable population growth, how does such a Ponzi scheme survive? Sydney just saw 3.8% property price growth in the single month of June, nearly double wage growth for an entire year. How is that sustainable? Speaking of sustainability, how about government deficits? This year's budget forecast is for a deficit of 5% of GDP after last year's near record 7.8% of GDP. Asked at what point over the next 4 decades the budget deficit would shrink to 1% of GDP, 3 panelists replied, never. 6 others said not before 2030. Only 4 nominated the decade ahead. Sustainable? Rising inflation and a slowing economy leads to stagflation, and that will not be tolerated. The RBA is facing a worsening picture. It has nowhere to go on rates. Its yield curve control program has its limitations if borrowing slows, and that leaves outright QE to keep things sustainably accommodative. But will the introduction of QE amid the Joe public perceived Goldilocks economy spook the market? You can, of course, follow the Fed's lead and say one thing and do the other. The following is an excerpt from a recent Crescott article and a fitting way to leave you. Pay attention to what they do, not what they say. It is a striking contradiction that the Fed decided to pivot the market narrative to its openness to tapering, though not raising interest rates until 2023. Meanwhile, it just reported that it added the largest amount of assets to its balance sheet in over a year, nearly $200 billion in the last 4 weeks, per their own statement below. The Federal Reserve will continue to increase its holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward the committee's maximum employment and price stability goals. It looks like the "at least" part came in handy this time round. It was the opposite of a taper. If we could use the best analogy to describe their message for raising interest rates into plain words, it would be the "we are debating if we should start a diet 2 years from now." Well, that's all for news today, guys. Hope you've enjoyed your week and you have a good weekend ahead. For any gold and silver products, please visit ainsleyBullion.com.au, and for any of our crypto products, visit ainsleywealth.com.au. Thanks for listening, and we'll catch you on Monday. Bye.